Hello, this is Melissa Buckley with the Pacific Gas and Electric Company Multifamily Upgrade Program. We're going to go ahead and get started with the second in a four-part series webinar training on asset management. Today, we've got John Rockwell with us of Partner Energy, National Client Manager. He's going to introduce himself in just a minute here, but first I'd like to just tell you a little bit about how to use the GoToWebinar features. So you should see on your screen a toolbar to the right. That's the GoToWebinar toolbar. You can minimize it or expand it. We will be able to take some questions throughout the presentation today if you do have them. So if you do, go ahead and either raise your hand and we can get your question that way, or type your question into the questions box. And we'll take those in the order that we receive them. We will be posting the recording of the webinar at the completion later today, and we'll also have a PDF of the slides available. Some of you may have joined us for part one and may plan to continue to join us throughout the series. If so, you will need to register for each webinar every time. So just pay attention to that. We usually send the registration link out about 2 weeks in advance of the webinar. So with that, I'd like to turn it over to John. He's going to go ahead and introduce himself and get started.
Hi, thank you, Melissa, and welcome everyone. Welcome back to people who attended the first course, and a new welcome to the people who are attending for the first time. Like Melissa said, my name is John Rockwell. I'm a National Client Manager at Partner Energy, and Partner Energy is a full-service energy consulting company. We may have worked with some of you on MUP projects in the past, and a couple team members, myself included, have an interesting, non-traditional engineering background. We actually came from commercial real estate finance. So prior to Partner Energy, I worked for a couple different private equity investment companies who managed funds of real estate buildings, assets, projects, and I was on the asset management side, so I did the day-to-day work that we're hopefully going to be talking about today and throughout the course, and give you a little under the hood look at what an asset manager is doing when they're thinking about a real estate property, both with energy efficiency projects in mind and sort of the global motivation of how they're looking at the pro forma process or the re-underwriting or the underwriting process in terms of reporting to the decision makers, the building owners, the financiers, the investors who are actually putting the money into the projects. So with that in mind, the course agenda for this four-part series can be broken down into these 5 points: basics of commercial real estate, introduction to valuations, the pro forma process, in particular the MUP measures and effects on sort of how a asset manager is thinking about the property's performance, and then last but not least, partially depending on how much time we have, because the first 4 bullet points are very meaty in and of themselves, a brief discussion of the investor confidence project and what that means as sort of engineering and sustainability professionals. So for today, we're going to zero in on an introduction to valuations, what that concept is, what the motivation and methodologies are behind it. But before we do jump into that new material, let's take a little bit of time to briefly review the salient information from the first course. Obviously, this will be a little redundant for the people who are joining us for a second time. For the people that are new, hopefully this is a little helpful in bringing you up to speed on what has been covered in the past. So a month ago, we spent a lot of time talking about the real estate business cycle, and how it's not unique to real estate in and of itself. Sort of most economic industries are subject to this similar type of boom and bust cycle. And then we talked about the 4 phases that make up the cycle, the recovery, expansion, sort of the upsloping boom periods of the cycle, and then the oversupply and recession, the downsloping bust of the cycle. And so where are we now in commercial real estate? We're somewhere in the expansion phase. The most optimistic economists would say we're probably in the number 1 or number 2 expansion bar, and maybe the more pessimistic, cynical ones would say we're somewhere in the 3rd expansion bar. So with that in mind, asset managers, their roles and responsibilities are, as it relates specifically to the building, to manage the property management company or people that are on the ground at the building on a day-to-day basis, and manage the repositioning and value enhancement of whatever the plan is for that particular building. So taking a step back, the asset manager, they're not involved in the first circle, in the acquisition. They're not scouting or scouring the market for opportunities for new buildings and then doing the initial underwriting of that opportunity and presenting it to owners or investors. They get handed that building and that underwriting package and that business plan after it's already been purchased. So they're now responsible for making sure that plan gets executed in a hopefully successful, at least thoughtful manner. And then they'll lead the property into the final circle, the disposition, getting rid of it, selling it, getting those gain on sale proceeds. So within those tasks, there's 2 broad categories. There's strategic decision making and tactical decision making. Strategic decision making revolves around the boardroom discussions, for lack of a better term. It's sitting down with your boss or the investor group that the asset manager reports to and evaluating the business plan for that specific building. Sort of the what are we going to do? And then the execution of that business plan, how are we going to do it? And then turning their focus to the external factors of, as an asset manager, I'm always trying to be cognizant of riding that business cycle wave. I want to look into the future and say, if I'm in a good place now in terms of the market performance, am I going to be in a better place in the future, or relatively the same, or something worse? And if it's something worse, what I need to do to prepare this building to successfully ride that wave. Tactically, on a more day-to-day task level, these things manifest themselves as monitoring the CapEx project budgets and the CapEx schedules, making sure that that part of the business plan, if it's a repositioning of a building, and by repositioning I mean you're taking a apartment building that it seems to be underperforming, and you have the opportunity to add value. Maybe you're renovating the apartment units or doing something else that involves spending money to elevate its status within that local market. So you can charge more rents and ultimately sell it for more than you bought it for. So monitoring those budgets and schedules to make sure those projects are happening according to plan. And then the oversight, but really communication with the property manager is so key, because you're really a team in making sure that all of those strategic decisions are executed correctly on a tactical level. It's a two-way street, and communication has to be frequent and open and transparent, and that everybody's on the same page in terms of executing the business plan. And last but not least, you are now putting on the hat of that acquisition team that initially sold the project, figuratively, to the investors as a good idea to do. You are re-underwriting the project using your own pro forma and confirming the valuation that was initially done, or possibly changing the business plan if something has gone wrong. So the idea there is that you're kind of coming full circle, and that the re-underwriting valuation task feeds directly into the strategic idea of always evaluating the business plan and making sure your best foot is forward. So re-underwriting and valuation, it can be a direct consequence of a negative event. Maybe the market crashed and you need to re-underwrite your assumptions for the building's performance. But maybe it's a ongoing maintenance thing. And by maintenance thing, I mean the investors who ponied up the money are asking you to redo the underwriting and the valuation on a quarterly basis, just to make sure that everything is like we thought it was. And if there are any small adjustments, we can get out in front of them. And again, the tools that property managers use to make all this happen include obviously property level budgets, market data to try to see that real estate cycle from a broader perspective, third-party professional data like appraisals and due diligence site assessments, and especially that's key for any like refinance operations that might be happening throughout the life of the investment. And then last but not least, the pro forma, which is the thing that we'll be spending most of our time talking about. So again, what is the pro forma exactly? It's a overly vague word, I think, that describes something that's sort of fundamentally simple. It's a tool used to calculate financial results of a specific investment. It's how you derive the return analysis for an investor, and a return analysis is more or less how much money they put in, how much money they get out or have to put in over the life of the investment, and then how much money they get out at the end. So those are the three critical components that the pro forma is communicating to the ownership group, to the investors, to whoever's putting the money up to finance the project. So if we take a hypothetical scenario of an asset manager is doing a sort of routine re-underwriting, maybe it's that quarterly re-underwriting of a building that isn't necessarily showing any major problems, but they're just doing a re-underwriting because they have to. That asset manager goes out to lunch with his or her boss, and they don't have computers in front of them, they don't have any reports, but they just start casually talking about the re-underwriting for that specific building. These are the 6 key assumptions that will inevitably be discussed or asked by the boss during that discussion. And here they are: general economic conditions, rental rate growth, occupancy, exit capitalization or cap rates, loan underwriting parameters, and year of exit. So let's talk about those in a little more detail. I think general economic conditions, we're all familiar with what that means by now. The boss will say, where are we in the real estate cycle? Are we gonna go off a cliff tomorrow, or are things going to continue in a positive direction? So referring back to the clock version of that real estate cycle graph that we talked about last course, this will be very germane to that conversation. But the idea is to get as granular of a snapshot as possible for that specific property. So you're not going to be looking at a national forecast or tuning into CNBC to see what Jim Cramer, Mad Money, says about the economy. You're going to want something that is as local market focused as possible. So in our scenario, if we're discussing an apartment building in Riverside, we're going to want to see a market report, maybe by CBRE or someone similar, for Southern California apartment buildings, or maybe even better, the Inland Empire market forecast. Something to really dive deeper into what is happening in the local market, so we can better react to those external forces. And then hand in hand with that, how is that going to influence our rental rate growth opportunities? And this chart we looked at a little bit last time, but the takeaway is, are we on the upslope and we can be relatively secure in the idea of rental rates continuing to grow? are we approaching that peak, that demand supply equilibrium, and we might have to think about the possibility of rent growth declining. Similarly, occupancy follows the same concept. And occupancy, vacancy, two sides of the same coin. Are we on the upslope in terms of leasing this building up compared to the rest of the market, or are we reaching an equilibrium point and we might have to start considering the possibility of a downturn where we can't meet that occupancy improvement schedule that we hoped for, or that vacancy decreasing schedule that we hoped for? And now, these next three are a little new. I don't think we specifically touched on them in the last course, so I'll go over them briefly here, but sort of rest assured that they'll be talked about in more detail later on in this course and in the future classes as well. So exit cap rates or capitalization rates. This is probably the number one term that's thrown around at these type of lunches or at networking events. Everyone is always asking, what are the cap rates in your market? What are they going to be 6 months, 12 months down the line? Everyone's trying to predict it. And it's so on the tip of everyone's tongue because it's such a critical component to this teeter-totter equation on the right-hand side. As you can see, it's directly inversely related to the value of your property. So if we consider the NOI, the net operating income of this apartment building in Riverside being sort of a fixed known quantity, it becomes the fulcrum point of the teeter-totter. And as cap rates go down, the value of the property goes up. And vice versa, if cap rates are going up, the value of the property goes down. So when we're having that lunch and we're saying, oh, well, man, cap rates are going to go sky high next year, well, that is a direct and immediate red flag that the value that we think our property is worth is going to go down. And cap rates are usually, well, always expressed as a percent, sort of like an interest rate. So you'll see 2, 3, 4, 5% in good years. You'll see 6, 7, 8, 9, 10, 12% in downtimes. And then we kind of turn our focus externally to the debt that we may have already on that property, or that we need to get again via refinance or something similar. Can the property still get debt if it needs it? So we're gonna put on our banker hat and say the banks need to see a favorable loan-to-value ratio, an LTV. They need to see a favorable debt service coverage ratio, DCR. So we're gonna factor that into our pro forma model, pro forma assumptions, and sort of predict what we think they're going to need and make sure that our property is still able to satisfy that. And then lastly, the year of exit. If the original plan for this hypothetical property was a 5-year hold and we're a year or two into it, have things gone so poorly that we have to get out of it now? Or can we still hold on to it for the 2 or 3 years that we originally intended? Or have things changed so significantly that we kind of want to restart the clock and do 5 years from today? Is that even possible with the investors' money that we used to buy the property? Will they even allow us to hold on to it for an additional 5 years? Maybe they need it back 5 years or bust, no matter what. So those are the kind of considerations that need to be thought about when examining the exit year. So a pro forma is a valuation tool. So let's talk about valuation methods and then get into the specifics of what is applicable to our pro forma tool. So I think you're all familiar with the valuation concept to one degree or another. Fundamentally, valuation means what is the dollar value of real estate? That's it. All we're saying is how much is this real estate worth? maybe we're saying how much is it worth today or how much will it be worth in the future, but critically, we're asking, what's it worth? Three popular valuation approaches, so the macro buckets of valuation approaches for commercial real estate are here: the income approach, the comparable value approach, and the replacement cost. So the income approach is really the primary concern of commercial real estate asset managers because it deals directly with income producing properties. If you think back to the first 5 minutes of the first course, we defined commercial real estate as virtually any property that's producing income on a sort of regular, repeatable, dependable basis. And so that makes the income approach sort of critical to what we're trying to do as an asset manager, because we're always dealing with income properties. The comparable value approach, which is not to say it's completely ignored by asset managers. It's taken as a data point when you're trying to determine, what buildings are selling for in the market, but it's not a fundamental part of the pro forma in the way that the income approach is, and I'll get to that in a second. But the comparable value approach is what we're all familiar with if we've ever bought or sold a home or a condo. It's what the appraiser does. They go around to your neighborhood, they see homes that have sold in the last 12 months that sort of have similar characteristics to the house that you're selling and buying, and it's like a peer-to-peer comparison. They're using those recent sales as a predictor of what your property is probably going to be worth. And then lastly, the replacement cost. This is really germane to new construction projects in particular, because you're sort of putting your blinders on and looking specifically and solely at what are going to be the material and labor costs to replicate and replace this building if I need to. So it's not always applicable for scenarios outside of new construction or relatively new constructed buildings. For asset managers, there are two investment approaches within the income approach itself. So we just said that the income approach is what is focused on for commercial real estate projects. Within that approach, there are two groups of metrics. There's the single period metric and the multi-period metric. And what that's really referring to is, in a single period metric, you're looking at all of the money that has come in or out of that property, sort of as a purchase price or an improvement cost or income that has come off or sale price that has come off of the property to the ownership. You're looking at all of those cash flows at a single point in time. So the cash on cash, the first bullet point here, the cash on cash or return on equity, what that's saying somewhat intuitively in its name is how much cash am I getting out for how much cash am I putting in? If I put $1 million into this project and I get $2 million out, my cash on cash return is a 2. 2 million divided by 1 million. It doesn't take into account any time considerations at all. Secondarily, the income capitalization, that's what I was talking about earlier with the cap rate and the teeter-totter. It's not thinking about a 10-year hold or a 1-year hold. It's purely a moment in time when you have the income that the property produces on an annual basis, and you're dividing it by the cap rate to arrive at a value for the property, at an income-related value for the property. So it's great for when you're doing a sale and you need to determine quickly what you think the market is going to be able to bear, but it's not great for communicating the value of the investment to an investor when they're trying to figure out what to do with their money. And by that, I mean, if we look at the multi-period metrics, the major consideration here is that the multi-period metrics are now taking into account time. So we have a discounted cash flow analysis, which takes into account time value of money. And the most common metrics with that methodology are the net present value, NPV metric, and the internal rate of return, the IRR metric. And so let's talk a little bit about the time value of money, because for me, it's not an intuitive concept. It's something that I always have to go back to and sort of refamiliarize myself with. So I thought we could take a tour what money really means. So it's a
John? John, are you there?
Muted.
for a minute. Melissa, are you on the line?
Unmuted.
I'm here. I'm not sure what just happened. We had a technical moment there, but I think we're good to go again.
Okay, great.
Okay.
All right, cool. So what we're really referring to with time value of money is what is the value of my money over time? And I know that's a little circular logic, so but please bear with me for a moment. The intuitive concept of that's sort of a capitalist motivator, is more money is always better than less, and getting money sooner is always better than getting it later. So those are the driving factors that'll influence or educate our decisions as we go through time value of money scenarios. So let's take at its most simplistic a simple decision. Someone offers you $100 now, or someone offers you $100 in 5 years. So if we sort of roll this back and think about those intuitive concepts, $100, $100, those two options, there's no more or less there. They're both $100. But sooner is better than later, so of course we're going to take $100 now. I don't think we needed a class to determine that. But if we unpack it a little bit and think about academically, why are we choosing $100 now? Let's run through it real quick. Well, first, there's no risk. You take the $100 now, that's great, you have it in your pocket. If you agree to take it in 5 years, okay, fine, but what if the person giving it to me is not there anymore? What if the person giving it to me, they don't have it anymore? Any number of things could happen externally, internally, that greatly elevate the risk versus essentially no risk in getting it now. Secondarily, higher purchasing power, and that can be really illustrated if you think about housing prices. If you think about what a $400,000 house gets you today versus what a $400,000 house got your grandparents 50 years ago, that's a classic illustration of higher purchasing power. 50 years ago, $400,000 would get you the nicest house on the block. Today, it'll probably get you the cheapest house on the block. So we had a higher purchasing power taking that $400,000 in the now 50 years ago versus waiting for that value today. So with $100 now, we have a higher purchasing power. And then not completely unrelated to that is the opportunity cost associated with taking $100 now versus in the future. And we have to think about what opportunity cost means for us as an investor or a holder of this money. It can mean different things to different people. If my opportunity is shoving that $100 into my mattress indefinitely, maybe it's not as big a deal if I wait 5 years and get that $100. But if my opportunity is to put that $100 in a savings account and start earning interest, in 5 years I'll have much more than $100, and the difference between whatever interest I earned and that $100 that's offered in the future, that's really the opportunity cost. And maybe there are more lucrative opportunities for that $100 that I haven't discovered yet. But that plays into the decision-making process. So obviously, $100 now versus $100 in 5 years, take it now. But what if they sweetened the deal and said $100 in 5 years, but hold on, I'm going to give you 10% compound interest on that $100 over those 5 years. Well, okay. Now I have no idea what that means. He said $100. I don't know which one. So going back to the first bullet point here, more is better than less. I don't necessarily know if with 10% interest is more or less, hypothetically speaking, than the $100 that I would receive today. So let's look at it mathematically. The present value of what is being offered is $100. The timeline is 5 years. And they've said a 10% compounded interest will be applied. Compounded referring to each year that the interest affects the money, it takes into account the prior year's interest as sort of your new base amount. So you can see that illustrated in the chart below. So in the first year, 10% of 100, $10. We now have $110. So in year 2, that 10% is being applied to 110 rather than just 100. So I get $11 that year, bumping my total up to 121 instead of 120 if it was not compounded. So we follow that logic for years 3, 4, and 5, and we arrive at $161. So great. My intuition is kicking in, $161 versus $100. This is a no-brainer, easy choice, $61 versus $61 extra versus the straight $100 now. Or is it? If I think about the sooner versus later part of that equation and think about the opportunity cost that goes along with it, the question should really be, can I put today's $100 to work and make more than those $61 that I'll make with their 10% interest opportunity? And so making a sort of tenuous analogy, that simplistic concept is what asset managers are reporting to ownership groups and investors, whoever's putting up the money, whether it's an individual or a fund. The question that an asset manager is always defending and answering is, why is it better to put my money into this project than all those other opportunities that are afforded to me? You know, maybe I'll just take my $1 million for that apartment in Riverside and go put it in the stock market instead. Or maybe I'll put it in a bank savings account. So you're continually advocating for your opportunity to be the most lucrative, the most beneficial, the most enticing to the people who are putting the money into these projects. So going back now and looking at the variations on the income approach. Again, the single number or the single phase analyses, the cash on cash, the income capitalization rate, those do not take into account any of the time value of money concepts we just discussed. It's exclusively for the discounted cash flow analysis. So which is best? Well, maybe best is the wrong word because it's a little bit like apples and oranges. But for our purposes, discounted cash flow is the only truly valid way to measure returns for the owner, for the investor. And why, reiterating some of the points I just said, it fully accounts for the time value of the money. It allows for variable cash flows, money coming in, money coming out, and when that is happening to all be accounted for in terms of generating a return percentage. And then it allows for differential growth rates of income and expense items. So we have income doing really well sometimes, we have income doing quite poor other times, and that all flows through to the bottom line that investors are looking at. And again, it's all related to time. When those things are happening are accounted for and reflected in the metric, in the IRR metric, in the NPV metric. And again, I sort of apologize for talking academically about these concepts rather than jumping into the formula specifically. But my hope is that when we do, if we do this sort of conceptual discussion of these concepts first, it'll provide a nice foundation for diving into the formulas and the equations later on when we're actually looking at the Excel sheet itself. So if this is infuriating, please bear with me. We will get there. So again, the discounted cash flow analysis yields two key benchmarks: the net present value and the IRR. Those are presented as percentages. So the investor is coming to you and saying, great, this deal sounds very interesting. What is the NPV? What is the IRR? You'll tell them something like 20%. And they'll go back to their financial advisor and they'll say, well, I can get 15% in the stock market. I can get 10% if I put this money in bonds. So this 20% deal sounds great. Let's do it. So where are we now? Where in the big picture are we now? We know that a pro forma is a tool for financial return analysis. We know that the valuation is simply a method for determining property value. And we also know that as an asset manager, our preferred valuation method is the discounted cash flow. That's the one that we've sort of hung our hat on, that everyone wants to use. So we can package that all together and confidently say that we all know that asset managers evaluate returns in a pro forma tool using discounted cash flow valuation methodology. Now, what that gets us, other than sounding really smart at the next water cooler discussion, I can't say for sure. But what I'm hoping is that it uncovers a sort of fundamental understanding of what an asset manager is trying to do when they're making their day-to-day decisions. And when we're presenting to them our energy efficiency recommendations, our payback periods, all of those sort of financial motivators that we're trying to present to the decision makers, if we have this in the back of our mind, we now know our audience a little better. We know what they're looking for. We know what they sort of hold dear, and we can tailor our the case that we're making specifically to that frame of mind. Now, this is not to say that these valuation methodologies are not without inherent risks, and this applies to both the multi-phase valuation techniques and the single phase, the discounted cash flow and the simple ones as well. So these are all generally revolving around the uncertainty of the assumptions that we're going to make because we can't predict the future. But let's just talk about them a little bit in more detail. Stabilized pro forma net operating income. So again, the net operating income, the sort of ultimate money that the property is throwing off every month, hopefully it's positive. If expenses are greater than revenues, it's going to be negative, so it won't be throwing off any money. It'll be essentially asking for money. But the that off-putting of money through net operating income, that's the critical part of communicating all of the financial success or failure of the project to the investors. So when we're stabilizing that and saying, look, investors, this is the pro forma, and this is how we're arriving at a net operating income that is bountiful and stabilized, there are inherent risks in saying that, because obviously we don't know the future, and there's many little variables that go into determining that, which we'll talk about in just a moment. So moving on to number 2, the projected changes in operating expenses and base revenue, that feeds right into the net operating income concept. We're projecting how those operating expenses are going to grow or shrink over time, and we're also projecting how the revenue, those rental rates in the apartment building, are going to grow or shrink over time. And so there could be unforeseen changes, obviously, that we're not going to account for. Maybe the utility company jacks up its rates in an exponential manner that we were not forecasting. Well, that has to be accounted for. Maybe there was deferred maintenance that we didn't see during the due diligence process that is now sort of surprising us a little bit. Likewise, on the revenue side, maybe there's more opportunity for higher rents, or maybe we overestimated and we can't grow the rents like we thought we did or thought we could. Thirdly, the projected selling price or refinancing value, that is a continuation of the theme. What if the cap rates that are helping drive that sale price are not what we thought they would be? Or what if our NOI is not where we thought it would be? The estimated holding period, that can have ramifications sort of up and down the stakeholders. If the people providing the money need their money back in a certain period of time, the holding period could be a very sensitive thing, and so we need to be cautious and sort of sound in our estimating of what the holding period will be. And then these last 2, reinvestment opportunities and tax effects and financing effects. These are really talking to sort of the fund investor money specifically, and saying what is the other opportunity for that money, rather than up in the project that we're creating a pro forma for. So we can't show in a pro forma how the money that is being generated is able to be reinvested in other opportunities, either inside the project or outside the project. It's just a blind spot that would need to be looked at outside of the pro forma. And similarly, tax effects and financing effects, those are below the line concepts, sort of below all of the property income statement, balance sheet items that would affect the investor's motivation specifically, and we can't always capture that when we're doing a pro forma. So let's go back to the scenario of I'm an asset manager and I'm going out to lunch and I have a project. But this time, instead of going out with your boss to lunch, you're going out with the new hire. And after lunch, the new hire is going to go into an extensive training about the ins and outs of pro forma analysis and all this good stuff. And they ask you as the asset manager, tell me what the basics are of this discounted cash flow concept. Tell me what the main motivations are within the discounted cash flow pro forma valuation. What do I really need to be concerned about? What's the overly long sort of bumper sticker takeaway from what I need to be concerned with? Well, you would say something along the lines of these 5 things. We need to understand how the money is being used that we're asking for. We need to really understand the operational characteristics of the building, and that's something that we're going to talk about at great length. and then financing, how is it going to be paid for, and then reversion and taxation. So continuing the sort of soft running theme of trying to demystify some of these overly complicated words, reversion, all that means is what are our net sale proceeds going to be? The people that have an investment in this property, what are they going to get out of it? Simple as that. And then what's the taxation effect going to be? So these are the 5 major concepts, and more specifically, some of the investment outlay typical things you'd see are how much would the land cost to buy? How much would the building cost to buy or build? And then what are the depreciation methods associated with these acquisitions and the useful life of any equipment or assets that are being purchased as well. Then operational characteristics. Again, this will be a major part of the course ongoing, but so 4 high-level examples are rental income, vacancy and collection factors, operating expenses, and how that all changes over time. Are we predicting it to go up or are we predicting it to go down? And then financing. Who is putting up the equity? Who's putting up the debt? Maybe if I have a very wealthy individual, maybe that individual is putting up all the money to buy the property. So I don't have to go to Bank of America and take out a debt loan. But if I do, what's the amortization schedule and interest rate on that loan? I need to make sure I understand that so I can understand how we're going to make money on this project, how we're going to pay back the investor on this project. And then, again, the required rate of return, something I've touched on previously throughout this particular course, is sometimes the investors have their own requirements. Their financial advisor has said, look, you can make that 10% somewhere else that's less risky, stock market, bond market. So when you go into this real estate deal, you better be telling these guys that you have a required rate of return of 11% a year. So if that's out there, we need to know about it and we need to account for it in our model. We need that reflected in the model and built into our assumptions. So when we're evaluating a potential deal, potential building acquisition, we can use that as a sort of baseline screen for profitability. If we don't meet that, then there's probably no point in doing it. And then reversion, again, how much money are we going to get at the end of this whole thing? Obviously, the key metrics feeding that are how long are we going to hold on to the property, what's the terminal or sale value, and then how do we pay off our debt if we have any, and then any reversion specific expenses. Do we have sale commissions to brokers or things like that? And then taxation, how do we handle those below the line things for the investors? Do they have to worry about capital gains or other minimum taxes that might influence their decision on how this money is being handled? So now let's think about a pro forma within, well, let's think about a discounted cash flow pro forma and really dive into the building characteristic vocabulary, because that's going to be the main driver. That's going to be the engine of the analysis. That's all of the market data that the asset manager is collecting. That's all of the rent roll information. That's sort of all the nuts and bolts that are driving the results of this analysis. So let's run through these vocabulary terms and then look at a real life example briefly of how it translates into an actual page from a discounted cash flow analysis. So when we're looking at the property, we're obviously asking how much income is the property going to give us. And so all of these things on the left take that into account. And then we're obviously asking how much are we going to be on the hook for expenses when we're operating this property. All of the red in the middle column items are the expenses that are germane to that operation. And then the result, taking the expenses away from the income, that gets us the NOI represented here on the left hand or the right hand side in the blue. That's how we ultimately arrive at the net operating income. So income vocabulary, just going down. So I'm going to go down the line here, rapid fire. Scheduled rents. This is what everyone has agreed to, sort of the strategic boardroom discussion. These are the rents that we expect to get on this project, the long-term goals. And then actual rents, the actual in-place rents as of today. This is coming straight from the rent roll. This is reality. And so when we have those two pieces of information, we can derive a loss to lease item. And that shows us sort of how far away from our goal the present reality is. And so when we're presenting the property performance to an investor, they're looking at that loss to lease and saying, that better be approaching zero over time. Otherwise, that's a clear indicator that you're not meeting your goal, at least on the revenue side. And then we have reimbursement income, usually in the form of RUBS. If the owner is paying for all the utility bills, they're able to reimburse the tenants for a portion of that based on some agreed upon metric, either occupancy or the tenant square footage or the number of beds, something like that. And then other income, any income outside of rent that the tenant is paying, usually parking, laundry, extra storage, those type of things, that should be captured here. And then the sum of all of those things come together as gross projected rents. So when we say rents in that case, it's not a literal rent that's only being captured in the actual rent line item. This is more of a figurative. What's the value of what all the tenants are paying for? So we take that all into account. Then we move on to the negative income items. These are still in the income section, but these are all going to be negative, taking away from that gross rent item. So vacancy and occupancy rates, how many units do we have empty that we need to show? And then rent concessions. If we're asking for $1,200 a month, but we're having trouble getting tenants to jump on that, the leasing office might be offering 2 months free. And so we have to account for that here as a negative item. And then any office or model unit or units, if it's a big property, we might have multiple model units. Those need to be shown here as sort of not double counting any potential rent. Those are never going to have any rent associated with them. And then delinquencies, tenants who are behind on their payments. And we can sum all of those negative items up and call it a total vacancy. Again, it's a figurative vacancy. We're already capturing the literal vacancy in the line item just above it. So our figurative total vacancy are all these negative income items. So now we can calculate effective gross income. That is the sum of total vacancy taken away from the gross projected rents. All of our negative items taken away from all of our positive items. Switching over to the operating expenses. These are all things that you're probably very familiar with. Real estate taxes, they need to be paid on an annual basis. Payroll, all of the staff directly associated with the property, that's coming out of the property's budget, not out of someone else's budget that's not on these books. It's directly represented here. And then building operations and maintenance, all of the non-capital expenditure items, all of the recurring things we expect to happen on a monthly basis, like landscaping, and repairs and maintenance, department turnover, that needs to be captured here. And then our favorite, utilities, water, trash, electric, and gas, steam, whatever else is applicable, that needs to be captured here as well. And then let's not forget about soft costs, those costs that aren't directly related to the operation of the building physically. Things like marketing, office management, administrative items like insurance, and then management fees. If you're not using your own property manager, you're probably having to pay a property management company to do the management. And last but not least, reserves, capital expenditures. that's essentially our contingency. How much are we saving for a rainy day? If we see a capital expenditure three years out, maybe we'll start saving for it now. Or maybe it's a true reserve. We don't have a specific item that we're saving for, just for the rainy day if something goes wrong. So when we sum up all of those expenses and we take them away from the effective gross rents, we're left with NOI. So the ultimate indicator of the property's current performance. And so how does this look on a sort of real life discounted cash flow? Well, for those of you that are maybe familiar with sort of non-real estate finance, this is very similar to an accounting income statement. So you see all the same indicators here. But let's translate the vocabulary list that we just ran through to this real life example, because not everything we talked about is here, and some things here are reflected differently. So our potential gross income, that third row, that is the sum of all of our positive income items. So you can see this one, or this discounted cash flow model only has base rents and a reimbursement of triple net items, similar to the RUBS concept. And then when we take into account our negative income items, we're able to have a sum of effective gross income. In this case, their negative item, it looks like a land lease provision that they're locked into. So they're not, this isn't particularly taking into account occupancy, vacancy, rent concessions, those type of things. But it's still showing the concept of the negative income ultimately producing our total gross income, our effective gross income. And then in the next section, we have the expenses. This is pretty similar: the property tax, the management fees, the insurance, repairs and maintenance. All those things look very similar to what we're used to seeing in like apartment type situations. So we arrive at the total operating expense. That gives us our NOI when we take the total operating expense and subtract it from the effective gross income. And now here's where we start looking at the time value of money. And this is where the analogy of an accounting income statement breaks down, because usually on an income statement, you're not seeing this time value of money analysis factored in. So what's going on in the row below the NOI is the question is being answered: what is this NOI worth in today's money if I think there's a 9% interest rate for the value of that money? And you know how that 9% was arrived at, that's a whole nother lecture. But the market analysis that was done has determined that 9% is a fair value versus other performance indicators in the market to think about for this particular project. So where this arrow is pointing in year 5, that 115, that is today's value of the NOI of 185,000 at a 9% discounted rate or interest rate. And so when we look to the right-hand side, the reversion column, that could really be called year 6. All they're doing is noting to you that that is the time of sale. So whether it's year 6 or time of sale, it's all the same thing. But what's important is that NOI, that 190,000, is what they are using to derive the sale value. So think of the teeter-totter. We now have our NOI, sort of the fulcrum of the teeter-totter. We now know that that is 190. And we also have our cap rate of 9%. So we're easily able to solve for the value in that teeter-totter equation. And that's what the sale value arrow is pointing to. The reversion derives from the capitalization or the cap rate of 6-year NOI, the 2.1 million. And so there are other rows here, obviously, below the sale price. And these are sort of continuations on the theme. they're more time value of money calculations, getting at sort of a real value of the property. And so we can talk about that now, or we can sort of save it for another lecture. But be rest assured that we will be doing this same analysis from scratch in our own Excel file in the next lecture. I think it's exactly 12, and not quite sure how I ended at exactly 12, but I'm happy to answer any questions, take any comments.
Go ahead and, thanks, John. Go ahead and raise your hand if you have a question, or feel free to type it into your questions box. All right. I don't see any coming through, so I think with that we can wrap up. We'll make sure
Yeah,
to,
so
go ahead.
So I can talk a little bit more about the future courses.
That'd be
Because
great.
one thing that was bugging me a little bit, and I alluded to it during this particular course, was sort of the lack of equations, so the lack of defining a lot of these terms in sort of a real Excel-based environment. So one of the things that we're going to focus on in next course, and my colleague Tony Liu is going to be joining the presentation, is he's going to be pulling up some of his pro forma discounted cash flow Excel models that he used to use in his real estate career. And we're going to be taking these concepts and laying them out in real time in sort of the actual nuts and bolts of how it's done. And so we'll both have snapshots of it in the PowerPoint, but then we'll also switch over to Excel, and you'll see some real manipulation. And just to sort of get the juices flowing, we're going to send coursework out to everyone at the end of that course, of letting them take home their own pro forma and saying, please mess around with this, please accomplish these tasks. And really, the hope is that it'll start taking these high-level concepts and really finally converting them into sort of some practical knowledge. So thank you all for bearing with me as I lay the foundation here.
Thanks, John. We actually had a question come in while you were giving us that preview from Richard. He's wondering, does each firm have an NOI that they calculate based upon their capital structure?
So no, and I'll tell you why. Because the NOI is disconnected from a firm's capital structure. So the NOI, and feel free to correct me if I'm misunderstanding the question, but the NOI is purely tied to the property's performance. The income that the property generates less the expenses that the property incurs. The firm's capital structure, that would all start taking place below the NOI line. And when I say below the line, I'm talking about in this section right here. So this isn't a great example of what you were maybe referring to when you said capital structure or capital stack, but NOI exists independently of the firm's responsibilities.
Oh, he has a correction to his question, if I can interrupt you.
Yeah, no problem.
And you know what, Richard, I'm going to unmute you. Make sure to enter your audio pin, and you and John can converse. I think you wanted to ask about sixth-year cap rate instead. So, Richard, are you there?
Yeah,
Go
I'm
ahead.
here. Can you hear me?
Yep.
Yeah, I apologize. I meant to say 60-year cap rate. the NOI that you use to you come up with the reversion value, that 60-year cap rate, which judges the NOI, is something that's, each firm comes up with their own based upon their projection of where their capital structure will be in 6 years. Just like you would say, what is your
Right.
discount rate that you want to use?
Right. So it's not. So in a sense, each firm has their own cap rate because there's no published standard cap rate. Sort of like a 10-year Treasury note. You can go to bankrate.com and see what the interest rate is on that Treasury. A cap rate is a little bit of a amorphous, trying to guess where the market is. So when you go to a networking event that's full of asset managers, they're all talking about what do you think the cap rate is right now for this type of apartment building in Riverside, or when you do look at those market reports that some of the brokerage houses or research firms put out, they do have their cap rate estimates in them, or at least the historical cap rates that they've seen in real sale transactions. So does each firm have their own set of cap rates? No. Each firm is always trying to figure out what the most realistic market cap rate is. And what it's really related to is going back to those different types of valuations. The cap rate is very much derived from that sale comparable valuation methodology. It's a little bit of a chicken and an egg, because you're asking, what's the right cap rate for my property? Well, in reality, it's whatever the market will bear. And the way that you're figuring out what the market bears is by looking at sales that just happened. So it's bringing in a little bit of that pure pressure sales comparable valuation methodology into the discounted cash flow study.
Okay, thank you.
Hope that makes sense.
Yeah, that answers it. That's what I was. Yeah, that's a better way of saying it. Yeah, you don't really have your own cap rate. You select what you think it'll be, but it's related to what else is going on in the marketplace.
Thanks, Richard. Any other questions? Feel free to raise your hand or enter a question into the box. All right. I don't think I see anything else. John, were there any other closing thoughts you wanted to share before we wrap up for today?
No, I think that's all that I had. If there are any questions, I put up the administration team page here. I'm happy to talk offline if anyone comes up with any questions between now and the next course, or has any constructive feedback. We want this to be tailored to be most meaningful for the audience. So we're not above changing on the fly or taking constructive criticism.
Right, and if you would all like to get in touch with John, feel free to reach out to the MUP team here and we can connect you. And like I said, we will post the recording along with the PDF of the slides to our YouTube channel and also have that available through or accessible through our website. So thank you so much, John, for presenting today. And we will send out the registration for the third session in a couple weeks. It's targeted for the first Wednesday in November, which is November 2nd, and then we'll conclude on December 7th. So have a good day, everyone. Thanks so much.